My name is Stephen Funk from the BYU externship team, and welcome to my presentation on alternative asset portfolio allocation. Over the past couple months, I've had the opportunity to both analyze and research various alternative asset vehicles, such as hedge funds, private equity, real estate, and fund of funds. Through my analysis and research, I've come to a recommendation for your endowment in terms of allocation for alternative assets in your portfolio. Of the $1 billion that you have available in your endowment to invest, I recommend that $350 million be allocated towards these alternative vehicles. As we can see in the next slide, of the $350 million, I recommend that 45% of that be allocated towards hedge funds, 40% be allocated towards private equity, and 15% towards real estate. I believe that with this distribution of alternative assets, you will be able to both realize the high returns associated with this asset class, while at the same time achieving diversification and minimizing your risk. I'd like to begin talking about hedge funds. Hedge funds are investment companies who, in addition to equities and bonds, have the flexibility to invest in various other types of financial instruments such as futures, swaps, options, and other financial derivatives. There are many pros and cons associated with this type of investment. The advantages of hedge funds are that, again, like I'd mentioned before, you can achieve a high level of diversification because of the high flexibility they have to invest in a variety of financial instruments. This is due to the extremely low amount of federal regulation associated with hedge funds when compared to something more like a mutual fund. In addition to that, another advantage of investing in a hedge fund is that generally they invest in very liquid assets. Finally, another advantage of hedge funds are that their historical returns are not highly correlated with that of the market. Hedge funds pride themselves on being able to outperform the market both in boom times and also in times of trouble normally in the market. And we can see that looking historically at returns of hedge funds. They have outperformed markets generally, and especially during the financial crisis of 2008, hedge funds lost much less than the market did. Some disadvantages of hedge funds are the layered management fees. And so in addition to a standard management fee that you would see at a mutual fund, hedge funds also charge what is called a performance fee, which is if the portfolio outperforms a certain benchmark, any performance and any returns above that benchmark, the management claims a certain percentage of that, which essentially lowers the investor's overall returns. And this performance fee, which they can charge, can be even upwards of 20 to 25%. In addition to this expense fee, hedge funds also employ what is called a lockup period. So this lockup period requires investors to maintain their holdings in the fund for a given number of periods, generally multiple years. And even when the time has come which allows them to withdraw their investment from the fund, these lockup periods can limit the investor on how much of their investment they can take out at each time. And so if a fund were to underperform, or if the market or if the overall economic condition were to go down and the investor needed liquidity, these lockup periods can prevent that, which is a great disadvantage associated with hedge funds. As we can see in this next slide, there are many different types of hedge funds of many different sizes which employ different strategies. This slide highlights some of the largest hedge funds in the world, some being Bridgewater, JP Morgan, BlackRock in particular. And each of these different funds employs a different strategy, which we will talk about in the future. But importantly, I wanted to point out on this slide the hedge fund managers. And so this is a very critical part when completing due diligence on which hedge fund you would invest in, as different managers have different capabilities and have proven track records. So that's very important to weigh when deciding which type of hedge fund to invest in. In addition to a manager, another aspect that you would look at when completing due diligence on a hedge fund would be the type of strategy. And so some of the most popular strategies for hedge funds are long-short equity, macro-driven, event-driven, relative value, and fund-of-fund strategy. So each one of these has different risks, different benefits, and in the end, different levels of returns based on the different characteristics of each one. And just to give a brief overview of the different types, long-short equity, again, as the name states, takes either long or short positions, generally in most equities. Macro-driven is looking at more of a macroeconomic view and how those different events will play out in the market and hopefully capitalize on correctly predicting those trends in the macroeconomy. The event-driven has to do with corporations and the corporate transactions with which they're involved and hoping to capitalize on price discrepancies which are caused by those corporate transactions from happening. The next is relative value. So relative value looks at the price of a given instrument based on a relative measure, be it the market or be it some other measure, and hoping to identify some pricing trends or pricing discrepancies there. And the final one is fund of funds. And so fund of funds is a hedge fund strategy in which instead of investing directly in securities, you will actually invest in various other funds and layer those returns on yours. So there again, there are pros and cons to each one of these strategies, but when completing due diligence on what you're looking to invest in, those would be the different strategies that you would. Again, my recommendation is that of the 350 million of your portfolio allocated towards alternatives, 45% or 158 million be left for hedge funds. We can see in this next slide summarize the annualized returns and the volatility of the different hedge fund strategies that we discussed. Those two factors are summarized in the next column by what is called the Sharpe ratio. So the Sharpe ratio is a measure that is used that measures both the return and the risk that you take on for accepting that return. So a higher Sharpe ratio states that for every unit of risk, you would achieve a higher return. And so when looking at these different hedge fund strategies, we notice that relative value with a Sharpe ratio of 1.8 is actually the highest of all the hedge fund strategies. The normal investor would think to just invest your entire portfolio that you have allocated towards hedge funds in relative value, but that would actually be incorrect because a total allocation in that one strategy would lack diversification, and through diversification you can actually achieve a higher Sharpe ratio by incorporating the different strategies. The way that I determined the allocation for the different hedge fund strategies to achieve an optimal Sharpe ratio was through what is called the efficient frontier model. So this model compares the returns and the volatility for the different potential assets for your portfolio, and through a creation of 5,000 random weights, identifies an optimal allocation across those different assets. So as we can see in this next slide, the efficient frontier identifies what is called a tangency point or an optimal portfolio allocation point. So this point runs tangent to all of the potential weights associated with the different assets and connects through a line which runs through the risk-free rate. Through this model, I was able to identify an optimal weight for each type of hedge fund strategy. The weights are highlighted on this slide. 7% allocation for fund of funds, 27% for macro, 45% for relative value, and 7% for equity hedge, and 14% for event-driven. On the next slide, we can see what this yields. With this allocation of assets, we can see an expected return of over 10% with a low standard deviation of under 5%. And again, as I mentioned before, we achieved a higher Sharpe ratio at 1.87% than any of the individual strategies combined. In addition to a 45% allocation in hedge funds, I also recommend a 15% allocation in real estate. Real estate differs from hedge funds and private equity in that the investment is made directly in real estate or other properties. And this type of investment also has many pros and cons. Some of the advantages of real estate are that since the investment is in a tangible property or real estate, investors have the ability to hold that as collateral and lower the risk associated with the investment. Some of the disadvantages, though, of real estate is just the uncertainty and volatility of the overall real estate market. As we saw in 2008 with home prices, real estate is subject to large drops in price and high volatility. Finally, I recommend that the remaining 40% of the 350 million allocated towards alternatives be invested in private equity. Private equity are types of investments in which firms buy entire other companies and over an extended period of time look to improve operations, improve efficiency, and at the end of the investment horizon, exit the company and realize a large return. And there are a number of different types of private equity strategies, but they all have the similar pros and cons. And so again, some of the advantages associated with private equity can be seen on this next slide. The advantages are, again, allows diversification in addition to hedge funds and real estate. And since private equity firms buy entire companies, they're able to buy both public and non-public companies. And these non-public companies you otherwise would not have access to in the normal capital markets. And since they buy the entire companies, they have a very strong influence over the management, both in who is managing the company and also the direction in which the company is going. Some of the disadvantages, though, of private equity is since you are buying the entire company, there is a lack of liquidity. And if in the event that investors need their money back, or if the deal is not going well, it's very difficult for private equity firms to exit that opportunity without suffering substantial losses. Again, another disadvantage of private equity is the long time horizon needed to achieve the returns that private equity that they're used to. But despite these disadvantages, it is very clear that private equity returns are substantially higher than that of normal market returns, and is very justified in investing in private equity. There are many different private equity firms with which you can invest in, but through my research and analysis, I've come to identify two in particular that I feel are strong and have a proven track record of success. The first of these firms can be seen on this next slide, which is the Blackstone Group. So the Blackstone Group was founded in 1985 by Peter Peterson and Stephen Schwarzman. And Stephen Schwarzman is still currently chairman and CEO of the Blackstone Group. And both of them came from Lehman Brothers after a long career in investment banking. And so some of the advantages of the Blackstone Group is they actually began as an advisory firm and have a various number of other branches within their private equity business. And so this gives them a very robust and expansive knowledge of the markets, both globally and across different asset classes. In addition to this, they have $205 billion in assets under management across these different businesses, which just shows their overall success that they've had. And one unique characteristic about the Blackstone Group as well is that in 2007 they completed an IPO, and so which means that they are actually a publicly traded firm, being one of the only publicly traded private equity firms. And so in addition to the normal management team of Stephen Schwarzman and Peter Peterson, they also have to keep shareholder interest in mind, which in my opinion will help them make both ethical and decisions that will keep the interest of the shareholders in mind. In addition to an investment with the Blackstone Group, I also recommend that part of your private equity investment be made with KKR. So as we can see on this next slide, KKR has recently been involved in some large LBO activity. And so this LBO that I'm showing was a $150 million buyout Flotilia. So KKR has a proven track record of success, and I'm confident that their expertise and success that they've had in the past will continue to trend that way in the future. In addition to private equity investments domestically, I also recommend that part of your allocation be made in private equity firms outside of the US. There have been many emerging markets which have shown a large GDP growth and a lot of potential for new acquisitions and LBOs. One of these markets that I've highlighted in this next slide is India. So India has the 11th largest economy in the world and a GDP growth of over 5%. And over the next years, it is expected that they will continue to move up and actually reach ninth in the world by 2014. And also, it's interesting to note that the drivers for growth in India have helped India become this leader. And over the past couple years, it's actually been the services industry, in particular the financial services industry, which has taken the lead in the control for the growth in India. And so I think with that in mind, it proves to be a great opportunity for both private equity and your endowment fund. In conclusion, of the $1 billion for your endowment, I recommend that $350 million be allocated towards alternative investments. And of this $350 million, I recommend that 45% be allocated towards hedge funds in the optimal portfolio allocation that we discussed earlier, with 40% of the $350 million be allocated towards private equity, and the remaining 15% being invested in real estate. I believe that with this allocation between different alternative assets, you will be able to diversify and manage your risk while at the same time realizing the high returns associated with the alternative asset class. Thank you so much for your time and look forward to speaking.